Well, it's very interesting. If you have a look at Australian investment grade credit versus US investment grade credit, the risk premium available at both is sort of very similar, but when you drill down into the markets, they're actually quite different. Australian investment grade credit is a market that has grown, but not significantly compared to the US market. So the Australian market is relatively under-levered, it's high quality, and it hasn't gone through that sort of that real growth spurt the investment grade credit has done in the US. If you look at the US market, since 2009 it's doubled in size, and it's now more than 50% triple B and longer in tenor. So what you've got a market which is roughly 6 or 7 trillion in size. You've got $3 or $4 trillion in triple B credit, and it's a lot longer tenor, so it's higher risk. So at this point of the cycle, what I'd rather do is actually protect capital by allocating into a less risky asset, being Australian investment grade credit. Hold some US investment grade credit, but two things, hold less of it. And second of all, when I do hold it in an active fashion, because then that gives me the ability to avoid those triple Bs, which we think are not you're not getting paid the risk for, but also to that harness some of that credit risk premium. So really the bias is to a very deliberate bias towards Australia at this sort of late point of the cycle, because we think that's actually going to give you a better risk return trade-off. In terms of Australia, I think the Australian corporates, and it's one of the reasons why we like them, actually their serviceability and their leverage levels actually haven't gone through the roof as we've seen offshore. It seems to me that corporate Australia, at least in the bond market, their corporate memory seems to be intact in terms of they remember what happened pre the GFC. Back in the days where they were saying, the CEOs were saying, I'm worried about having a lazy balance sheet, I'm worried about being taken over, so hence I'm going to gear up and buy assets. That behaviour doesn't seem to be coming through, at least not in the corporates or the companies that we take exposure to. But we are always mindful of that risk, because what happens is that as you go through the next cycle, there will be companies that do come under pressure, but at the moment, through our sort of fundamental research and stock selection, our exposure to Australia means that we may have some volatility and variability in companies as interest rates or cost of funding increase. But at this stage, the way we've projected forward and stress tested some of these companies, there's nothing that we're particularly sort of concerned about from a credit investor's perspective.